So today our plan is to discuss still behind the preparation of financial statements. We are doing preparation of financial statements. Then already we discussed two important standards: inventory and property, plant and equipment (PPE). So today I'm going to discuss some other adjustments, which is very important to do to prepare the final accounts, financial statements, right? Okay. So today, what I didn't give a tune. I want you all to write, right? So whatever I am writing in the board, you all can write it. So I will the examples, very basic examples I will take. So you can write in your book. So write the heading. Write the heading. Adjustments. You can write accounting adjustments. Accounting adjustments. Accounting adjustments. So when it comes to accounting adjustments, there are important adjustments that comes for all the questions, right? We have different types of organizations: sole proprietorship, partnership, companies, non-profit organizations. So there are different types of organizations. So some adjustments comes for all these types of organizations. So I will summarize it. If we take the summary, number one, we have adjustments related to stock, adjustments related to inventory. So under the stock adjustment, we have the closing stock adjustment. Closing stock adjustment, right? So when it comes to closing stock, there is an adjustment related to cost and NRV. Cost and net realizable value. We need to take the lowest. So if the NRV is higher, NRV means the net realizable value, that is expected future price. So if the expected future price is higher, we will take the cost. If the expected future price is lower, we will take the NRV. Right? The difference, we need to write off that adjustment. We can discuss under the closing stock adjustment. Then there is another adjustment related to closing stock. We have stock drawings. In a sole proprietorship, we have stock drawings. The owner takes goods from the business. Double entry. We have to deduct from the purchases in the trading account. So trading account credit, drawings account debit. Then there can be stock damages. Stock damages. Maybe due to a fire or a flood or any other natural disaster, our stock, there can be a damages in stock. So we have to remove that from the account. And also sometimes there can be insurance claim. Insurance claim for this damage. 80% we receive insurance claim. Only 20% is our loss. So we will do the stock damages and insurance claim. And one more. Stock sold on sale or return basis. We are selling stock on sale or return basis. That means we are selling the stock, right? If it is sold, we consider it is sales. What's the double entry for sales? Credit sales, debtors account debit, sales account credit. Debtors account debit, sales account credit. Let's say 100. If it is sold, there is no issue. You can keep this double entry. But if it is not sold, then what happens? Still, the stock is remaining. It's returned. Remaining stock is returned. Let's say we sold 100, and there is a remaining stock of 50. 50% is remaining. So that should be deducted from the debtors and from the sales. I will explain this later. And the cost of this is the selling price. And the cost of this stock should be added to the closing stock value because it is our stock. We have given the stock on a condition sale or return basis. So these are the 4 important adjustments related to stock. So can you write this down? Write the main heading, accounting adjustments. The number 1, stock, closing stock, stock drawings, stock damages and insurance claim, stock sold on sale or return basis. Write down this. If you can't see or if you have any issues, just drop a message. Okay, number 2. Right. So number 2 is adjustments related to debtors. Adjustments related to debtors or trade receivables. Adjustments related to trade receivables. So what are the adjustments related to trade receivables? We have bad debt, unrecoverable debts. Either the customer has debt or he is bankrupted, so we can't recover the money from the customer. Bad debt. Then we have doubtful debt. Doubtful debt. So it is not sure about receiving the money from the debtor. We are not sure about receiving the money from the debtor. Doubtful debt. So under doubtful debt, there can be under provision. It's a provision. Under provision and over provision. And third one is discount. Discounts. Here we have discount allowed. Discount allowed. So write down these 2. And give 1 minute. Write down. Then we will move on to. Then we will move to the third one. So today, my main plan is to discuss not this, mainly the VAT and the accruals, and if we have time, we will discuss some. Then moving to the third one. Number 3. Number 3, we need to know adjustments related to accruals. So when it comes to accruals, we have expenses and income. We have expenses and income. Expenses we divide into expenses payable and prepaid expenses. This is according to the concept accrual concept. What is accrual concept? When preparing financial statements, we are not recording only the cash payment. If there is a payable balance, we need to consider that. And also, if there is a prepayment, we need to consider that as well. Accruals. Expenses payable and prepaid expenses. Then income receivable and income received in advance. Income receivable and income received in advance. Then number 4. So I hope everyone is writing this. Right? Number 4. Adjustments related to PPE. PPE means property, plant, and equipment. Property, plant, and equipment. Adjustments related to PPE. Land, building, vehicles, right? Machineries, furniture, equipment. Right? So under this, we have depreciation adjustment, and disposal adjustment. Disposal means either it can be a sale, transfer, giving up an old asset and getting a new asset, or it can be a damage. Right? So adjustments related to PPE. Then number 5. Number 5, we have adjustments for we take value added tax. VAT. So today I will be discussing this value added tax. The number 6, I will discuss adjustments for payroll. Payroll, the salary. Adjustments related to employee salary. So under this, we have EPF, ETF, employee provident fund, employee trust fund. Also we have pay tax, pay as you earn, pay as you earn. Right? So these are the main adjustments that we will discuss. Okay, so copy this. First, we will start with This. So I'm going to start with value added tax. Let's write the heading value added tax. Write the heading value added tax. Okay. So this is a very important topic. So definitely there will be questions related to value added tax. Right. So I want everyone to write heading value added tax. Right. So what is mean by value added tax? So it is a tax on goods and services. So earlier we had something called GST, goods and service tax. Then it was replaced from value added tax. Right? So this tax is paid by the final customer, paid by final consumer. Right? So this is tax on all the goods and services, and this is an indirect tax. Indirect tax. So the concept behind the tax, I'll explain the concept. Assume that we have a business. And here we have the supplier. We have a supplier. And the other side, I draw the customer. So in a business, what happens is we purchase from supplier, purchases, and we sell. Sales to customer. We purchase from suppliers and we are selling it to customers. Right? Now we will see how does the VAT is recorded, the accounting part of value added tax. So if the VAT rate is 8%, I'm going to take VAT rate. VAT rate is 8%. Now we are buying from the supplier, we are purchasing from the supplier. The value is 100. So if the value right here, if the value without VAT. So you can see that. Yeah. Value without VAT plus VAT is equals to value with VAT. So that is the normal calculation. Value without VAT plus VAT equals value with VAT. So if the VAT rate is 8%, if the VAT rate is 8%, value without VAT is 100. From this, VAT is 8. Then value with VAT is 108. If the value without VAT is 100, VAT is 8%. So we calculate 8% from this. 8% from this. Then value with VAT will be 108. Right? So what you need to remember, what you need to know is, if they have given this value, if they have given value without VAT, this is very important. To calculate the VAT, the equation is 100 into 8%, 8 over 100. 100 into 8 over 100. So sometimes they will give you this value with VAT. So if you want to go this way, then your equation will be, now you have 108, whatever this value, multiplied by 8 over 108, then only you get the VAT amount. So let me put it in a different way. So if it is getting confused, I will put this in a different way. Without taking 100, I will take a different value. Then you will understand in a proper way. So let's say the value without VAT. If the value without VAT is 2000, value without VAT is 2000, then how much is VAT? It is 8%. So how do you calculate? If you go this way, you calculate 2000 divided by 100 into 8. 2000 divided by 100 into 8. So you will get 160. 160. Then value with VAT will be 2160. 2160. Right? So this way. Then let's assume that VAT rate is given 8%. VAT is 8%. You have this value with VAT. From this, you are going to calculate the VAT. Then how do you calculate? You have this value 2160 divided by, this is equal to 108. This is equal to 100. So you divide by 100. This is equal to 108. Then you divide by 108, multiply by 8. So if you are going this way, 8 over 108, then you will get the answer as 160. Very important concept. So can you write this down? Calculating, how to calculate value without VAT and value with VAT. Either from this way or the other. Okay, so that is how we calculate the VAT amount, calculation of VAT. Now moving back to the transaction, we purchase from the supplier let's say without VAT, cost without VAT is 2000. The cost of the goods we are purchasing, the cost of the goods we are purchasing without VAT value is 2000. Then if we add VAT 8%, this becomes 160. So value with VAT is 2160. Let's take it. Value without VAT. Value without VAT is 2000. VAT is 8%, 160. Value with VAT is 2160. That is our purchases. This is our purchases. And we are going to sell this same stock. Then we are selling to our customer. Let's say the value without VAT is 3000. We buy at 2000 and we are selling at 3000. Then 8% VAT. 8% VAT. It is 240. 8%. 8%. Value with VAT is 3240. So that is our invoice value 3240. Right? How are you going to record this? What is the double entry for these transactions? Now, if you take purchases, double entry for purchases is a creditor. Double entry for purchases. Purchases account debit, creditors account credit. Purchases account debit, creditors account credit. Then if there is a value of VAT, this value, this okay, I'm sorry, it was muted. Now I think it's clear. Right? Now can you all hear? Can you all hear me now? Yes. Good. Okay. So I'll explain again. Now we are going to see the double entries, purchases and sales. Our actual cost is 2000. This 160 is VAT. And here our actual cash, our sales value is 3000. This 240 is VAT. But we receive cash. The business received from the customer 3240. Right? Even though we received 3240, 240 is not belongs to us. It is VAT. Business must pay this VAT to the VAT department in London. Right? So this is a payable VAT. We call it, this is a sales VAT. And also another term for this, output VAT. This is our output. Sales is our output. And this is purchases. We call it purchases VAT. Purchase VAT. Purchase VAT. Or input VAT. What we purchase is our material, our input. So that is why we call this is input VAT and this is output VAT. So output VAT is payable. We received 240 VAT from the customer. So that VAT we have to pay to the VAT department. We have to pay that to the government. So it is a payable. And what we paid, actually we have to pay 2000, but we have paid another VAT. So this 160 we can recover from this. So I will give the double entry for this. VAT, the purchases account debit, purchases account is debit only 2000. Purchases is only 2000. This VAT 160 is receivable VAT. What we do is we debit the VAT control account. It's a VAT receivable because we pay, we can recover the VAT. VAT control account debit 160. So total 2160. And we have to credit this, the total amount, we have to credit the creditor's account. So this is the double entry for purchases including VAT. Purchases including VAT. Purchases account debit, VAT control account debit, creditors account credit. Then, if we do the sales, debtors, customer becomes debtors, debtors account debit the total amount we are receiving from the debtors receivable 3240, the total amount, and sales account will be credited. So our sales is not 3240. Sales amount is 3000. We have to credit 3000 in the sales account. And the 240 VAT will be credited to VAT control account. So this is a VAT payable. This is a VAT payable. So we credit VAT control account. Right, so that's the double entry. Then if we prepare the VAT control account, VAT control account, this is debit 160. 160 is debit. We can say this is input VAT and credit. There is an output VAT of 240. So from the customers we received 240. From the customers we received. So that is payable to the government. And already we have paid 160. And so we can set off this 160 with the 240 total payable. Then actually we have to pay the net amount from this. So final payable, if you balance this, we have to pay 80 is the final payable balance carried down. Balance from 80. That is the final payable. So complete, write this entire note and complete this. In between, if you have any doubts, anything if you want to explain, just drop a message.
அம்மா எங்க போறீங்கடா? யா
Right. So now you can here. Okay. Right. So let's do an example. Example 1. Example 1. Okay. Following information given for ABC Limited. Following information given for ABC Limited. Balance VAT control account 1st of January 2020. VAT control account balance brought forward 50,000 credit. 50,000 credit. 1st of January 2020. VAT control account balance brought forward 50,000 credit. Then we have cash purchases. Excluding VAT. Cash purchases excluding VAT. Cash purchases excluding VAT 20,000. Then the third one, credit purchases including VAT. Credit purchases within bracket including VAT. $32,400. Credit purchases including VAT 32,400. Next one is cash sales. Cash sales including VAT 54,000. Cash sales including VAT 54,000. Then credit sales excluding VAT 60,000. When it says excluding VAT, 60,000. VAT rate is 8%. VAT rate is 8%. Prepare the VAT control. I will send this question. Right. VAT control account, and there is an opening balance 50,000. So can you all get the transactions which comes to the VAT control account and find out the closing balance? Find the closing balance. Purchases VAT will be debit, sales VAT will be credit. What you need is the VAT amount. If it is excluding VAT, I'll give a small note. So you can easily remember if they have given including VAT, if they have given including VAT, if this value includes the VAT, then 8 over 108. If it is excluding VAT, then 8 over 100. That's the way of calculating the VAT amount. Calculation of VAT amount. Calculation of value of VAT. So if it is 12%, then 12 over 112, 12 over 100. If it is 15%, 15 over 115. Okay. Right. So I'll give 2 minutes. I need the final balance calculator. Debit or credit, what is the amount? So there are some questions. Let me go through. Sir, is it okay to mention input VAT, output VAT without the VAT within the VAT control account without mentioning purchases or sales? Yeah, that is fine. Either you can mention purchases or sales as the description or input VAT, output VAT. That is not an issue. Right, then I hope now you all can see the board and clearly hear what I'm saying. So there are two answers: 54,800, 54,444. Right. So let's calculate. So opening balance is 50,000 credit. Cash purchases 20,000. So there is a purchases. Cash purchases. This includes, this is excluding VAT. Then we have to multiply. Excluding means 8 over 100. 8 over 100. Then 1,600. So that's the VAT amount. Excluding, we multiply by 8, divide by 100. Right, so this is then the third one, credit purchases including VAT. So if it includes VAT, we have to divide by 108, multiply by 8. So VAT on credit purchases. This is VAT on cash purchases. Then I will calculate VAT on credit purchases. 32,400 divided by 108, multiply by 8. $2,400. Debit 2,400. Then sales. Sales is output VAT. VAT on cash sales. VAT on cash sales. 54,000. Now it is including VAT. If it includes, divide by 108 multiplied by 8. So 54,000 that amount is 4,000. VAT on cash sales is 4,000. In the last one, credit sales, VAT on credit sales. That is from 60,000 into 8%. 4,800. So 800, 8, 58, 800. Our final payable. $54,800. So let me check the answers. Who has given 54,800, 54,800? Yeah. Okay, so almost everyone has given the correct answer. So that is that controller part. Very simple, right? Now you all can do a question from that. Okay. So more questions I will send after the session. So then next, what I'm going to explain is debtors, bad debt, provision for doubtful debt. Uh, so there is one question. How much is credit sales? Credit sales is 60,000. Can you all hear me? Yes. Okay. Thanks. Right. So let's discuss the next important adjustment. Bad debt and provision for doubtful debt. Bad debt and provision for doubtful debt. So I will be giving a full comprehensive summary. Okay. So what is a bad debt? Bad debt is unrecoverable debts. We have debtors. We can't collect money from the debtor. Either he may be dead or he is bankrupt. So we can't collect the money. Then this bad debt is an expense. So what's the definition for bad debt? Double entry for the bad debt account debit, because it's an expense. Debtors account credit. Bad debt account debit, debtors account credit. It is an expense. Okay. What I'm going to explain is doubtful debt. Doubtful debt. So doubtful debt means we are not sure about receiving money from the customer, money from the debtor. So this is a provision. Let's say provision. Provision for doubtful debt. We can divide this into two. Provision for doubtful debt we can divide into two. One is called specific provision. Specific provision. The other one is called general provision. Specific provision and general provision. So what is meant by specific provision? Specific provision means we make a provision for doubtful debt for a specific person. So for an individual person, let's say Mr. Pereira. So he is not a bad debt, but we make a provision. We are not sure about receiving the money from the customer, Mr. Pereira. So it is specific provision. General provision means from our past experience, we make a provision, a general provision from the total debtors, 10%, 5%, 2%. So it is from the total amount of debtors, we make a percentage. So here it's a person, here it's a percentage. Right? Then general provision, again, there can be under provision and over provision. So if it is under provision, this is an expense. Expense increase. Under provision means expenses will increase. Over provision means expenses will decrease. Expenses will decrease. Then there is one more thing. A specific provision becomes bad debt. We make a specific provision for Mr. Pereira and he becomes bad debt. Right? So let me give the double entries. Specific provision becomes bad debt. So let's write down the double entries for each of this. Bad debt double entry, bad debt account debit, debtors account credit. Specific provision, double entry will be income statement debit, and it is an expense, and provision for doubtful debt. Credit. Expense account debit, provision for doubtful debt account credit for Mr. Pereira. Right? Then the same person becomes bad debt. So if E becomes bad debt, again you can't debit the income statement. This is bad debt account is income statement. So again you can't debit the income statement because already he was treated as an expense. Now if we want to remove the person, remove Mr. Pereira, then we need to credit the debtors account, remove from the debtors account credit, debtors account credit, and this was credited to provision for doubtful debts or the allowance for receivable, we call it in different terms. So remove from the provision, then provision for doubtful debt account debit. So that's the double entry for specific provision becomes bad debt. A specific provision becomes bad debt. Okay. Then under provision. Under provision is same line. This income statement debit. Provision for doubtful debt account. Credit. Income statement expense account debit. Provision for doubtful debt account credit. We do few examples. For now you can write it. Over provision is the reversal of this. Provision account debit. Provision account debit. Income statement credit. So these are the ways, these are the types of questions we might get under provision for doubtful debt. Then there is one more part related to bad debt. Sometimes we collect the bad debt, recovery of bad debt. So bad debt means we are assuming or we are sure that we are not receiving money from the debtor. So if it becomes bad debt, if we recover that, it is an additional income, right? So it's like an extraordinary income. So again, now you don't have the debtors account because already the data has been removed from the accounts, right? So if you are receiving money, your cash or the bank will be debit, cash or the bank will be debit, and it is income statement. Credit. Or if we are preparing a common account, bad and doubtful debt. If you are preparing a common account for bad and doubtful debt, you can credit the bad and doubtful debt account. Okay. So copy this, you can take a screenshot. We have this full chart. So important adjustments, bad debt, recovery of bad debt, specific provision, general provision, under that, under over provision. So that's the complete summary on this. I'll give 1 minute for you all to complete. There are a few questions. Does specific provision mean special provision? No. Yes. Special provision. And so there are a few questions. Bad debt. What is the account? Is it an expense account or an asset account? It is an expense account. Under income statement, we record selling and distribution expense. Bad debt is a selling and distribution expense. Right? So bad debt is not an asset account, it is expense account. There was one more question to explain the specific provision. Specific provision means we know there is a person called Mr. Pereira, right? Let's say he need to give us 100,000. He need to give us 100,000. So we make a provision. It is not a bad debt, but especially we know he might not give money to us. So we will make a specific provision of 100,000 in our account, other than the general provision. I will do an example for a specific provision. Recovery of bad debt is income. So is recovery of bad debt an asset? There is one more question. Recovery of bad debt. It is income. In your income statement, under other income, recovery of bad debt means it is an extraordinary income. We have already expensed it. We have deducted from our profits. But it is suddenly this person comes to the business and he give us money. So it is an additional income. We consider it as other income. Okay, so you can treat it as two ways. Either we debit, we credit into the other income, and or else we set it off against the bad debt. If you have a bad debt account, we set off the credit. So the net amount only will be recorded in the income statement. Any other questions? So, recovery of bad debt. Recovery of bad debt is income. So I hope it's clear, Shihab, Ishma. Shehani, is it clear, the specific provision? Yeah, okay. Right. So we did value-added tax and bad debt and doubtful debt. I will do some example questions from this. So let's erase this. This is very important because the same concept, the same adjustment will be tested in your A-level, or if you are doing any other professional courses like AAT, Chartered, CIMA, ACCA. or banking, CMA, any course, adjustment will be same. Right? So understand the basics from the beginning, then it will be very much easier. Let's do an example. Example related to bad debt and doubtful debt. Example 1. Example 1. Write down this example. Following information given for advanced PLC. Following information given for advanced PLC. Trial balance as at 31st March 2020. Trade receivables trade receivables thousand. I'm bringing thousands, so this is 1 million trade receivables. Provision for doubtful debt. 1st of April 2019. Opening provision is 50,000. Then the additional information. Trade receivables 1 million, provision for doubtful debt, 1st of April 2019, 50,000. Additional information. Bad debt 100,000. Provision for doubtful debt 10% from the remaining debtors. Provision for doubtful debt is 10% from the remaining debtors. Okay. So what is required is ledger accounts and draft financial statements. Ledger accounts and draft financial statements. Debtors, there is an opening balance. Trade receivables, there is an opening balance 1 million. Provision for doubtful debt, opening balance is 50,000. That's the opening balance. So we need two ledger accounts and draft financial statement. I will prepare the income statement and statement of financial position. So the places in income statement under selling and distribution expenses, we need to show the expense, bad debt and doubtful debt. In the balance sheet, statement of financial position, under current asset, we have trade receivables and provision for doubtful debts. Okay, so draw this. I'll give 1 minute to draw this, then we will continue. Example. Right, so let's start it. Okay, so when you get a question, adjustment, accounting adjustment related question, whatever in the trial balance, only one entry, that is the additional information, double entry. additional information should be recorded in two places, right? So let's do number one, bad debt. What is the double entry for bad debt? I gave you in the previous summary note. Double entry for bad debt. Debtors account credit, bad debt account debit. Bad debt is expense. So we credit the debtors account, bad debt 100,000. Credit debtors account and debit the expense account. Expense account is selling and distribution expense. Bad debt 100. Double entry for bad debt. Then provision for doubtful debt is 10% from the remaining debtors. So let's calculate the remaining debtors. 1 million. Remaining debtors is 900,000. Remaining debtors value is 900,000. So the provision for doubtful debt is 10% out of this. So if you calculate 10% out of this, it is 90,000. 90,000. Right? So our provision for doubtful debt balance should be 90. Already 50,000 we have provided. We made a provision 50,000 in the last month. Last month 50 provided. Total should be 90. So 40,000 is the under provision. We have provided less. Under provision is 40. Credit, and that 40 is the expense. Is the expense. Doubtful. So total 90 is not the expense because 50 already expensed last year. Last year, expense account debit, provision account credited 50. So this year total should be 90. That means expense will be only 40. So debit expense 40 and credit doubtful debt 40. That's it. See, anything in the additional information we have recorded double entry. Credit 900, credit 100, debit 100. 100, 100. And 40 is our under provision. Here debit and credited to the provision for doubtful debt account. Then if you balance this 90, 90. So closing balances. Income account and expenses account. We take the balances to the income statement. So these two are expense accounts. We take to the income statement and that is all for that. But these are asset accounts, asset deduction account. The balances will be taken to the statement of financial position. Trade receivables 900. Provision is 90. The net amount is 810. So one by one we will go. This is an easy question. We will do some difficult questions, including bad debt, recovery of bad debt, specific provision. Okay, so I hope this is clear. If you have doubts, you can put it in the chat box. Okay, so this is the draft financial statement. Right. So there are questions. So if it is over provision, okay, I will explain that. If it's over provision, we either deduct in the selling distribution expense or, yeah. If it is over provision, we can deduct under selling and distribution expense, or else we can add under other income. That is correct. Can you explain under provision 40? Okay, I will do that. Yeah. So both are correct. Yeah, both are correct. No problem. So O provision also I will explain. Okay. So under provision comes here. So over provision, either we take on the other income or else we deduct under selling and distribution expense. Over provision. I will do a question. And there's one question to explain the 40 again. Right. So it's trade receivables 900. So they are saying from the remaining debtors, 10% should be the provision for doubtful debt. From the remaining debtors, 10% is 90. So provision for doubtful debt should be 90. So already 50 is there. 50 is already provided. So we have to provide only another 40 since already 50 is available in the account. Okay. Right. Do another question. Right. So we'll do example 2. We have a trial balance. With trade receivables 1 million, bad debt 30,000, provision for doubtful debt 200,000. Year end is 31st March 2020. Provision for doubtful debt 1st of April 2019. Then the additional information. Number 1, bad debt another 100,000. We need to make another 100,000 as bad debt. a specific provision of 200,000 is made for Mr. Pereira. A specific provision of 200,000 is made for Mr. Pereira, and the general provision is 10%. General provision is 10%. Specific provision is 200,000. General provision is 10% from the remaining trade receivables. Required the same things. So draw the formats. I'm going to draw the trade receivables account. And provision for our projects. Then the income statement. And the statement of financial position. So opening balances are given. Trade receivables 1 million. So trade receivable account debit 1 million. Trade receivable account debit 1 million. Provision for doubtful debt account credit 200,000. 200,000 we have to credit the provision for doubtful debt account. And in the income statement, we have selling and distribution expense. Selling and distribution expense already there is a bad debt of 30. So I didn't prepare an account, I directly take it into the income statement. I directly take the balance into the income statement. So these are the balances given in the trial balance. Okay. Write the balances. Right. Now let's do the additional information. So on additional information, we have the bad debt. Bad debt is 100,000. So what's the double entry for bad debt? It is trade receivables account credit, debtors account credit, and the bad debt account debit. So already 30,000 is provided as bad debt. So we need to increase it by another 100,000. So total bad debt is 130. Trade receivable credit, bad debt 100,000. So that's the double entry for the first additional information. 100,000. Now the important part is the provision. So here we have two types of provisions: a general provision and a specific provision. Right. So let's calculate the total provision for this. Okay. So let's take it here. We have trade receivables 1 million, and there is a bad debt of 100,000. So the net debtor balance is 900,000. That's the net debtor balance. If you balance this 1 million, 1 million, balance, write down 900,000. So for this 900,000, we are going to make a provision. So how are you going to make the provision? In two parts: specific, or we call it special provision, and the general provision. So specific provision means it is for an individual person. So who is that? It is Mr. Pereira. So from this 900,000, 200,000 is for Mr. Pereira. 200,000 is specific provision. Right? So for him, we will make 100% provision. 200,000. The entire 200,000 is provision. And what will be the remaining? If you take out 200,000, if you take out Mr. Pereira from this 900, the remaining is 700. The remaining trade receivables, we need to make 10% provision. That is, if you calculate 10%, 70. So the total provision for this year is 270. So total provision for this this year is 270. Right? So we calculate this total amount. Right? So we did the first double entry for bad debt. Then the second adjustment is provision for doubtful debt. Then we calculated the provision for doubtful debt for the total value 270. Now we will make the double entry for doubtful debt. So already 200,000 credited with the provision for doubtful debt. Therefore, under provision is only 70. It is a selling and distribution expense. Provision for doubtful debt 70. Total is 270. 270. The current assets, debtors 900, doubtful debt 270, net amount 630. So this is how we do. If there is a specific provision and a general provision. Let me know if there is any doubts. Right. So let's say, hope this is okay. Let's say the brought forward balance is 500. Then what do you do? If the balance brought forward, provision for doubtful debt is 500. I'm going to explain over provision. Now we have calculated the total provision is 270. Then this will change. This will be same, like I will explain. If the opening provision is 500, now we have calculated the closing provision should be 270. So here there is an over provision. How much is over provision? Your balance should be 270. That should be the balance. The difference will be the over provision. How much is the difference? 230. So this is provision account debit, and you have to credit 230 minus doubtful debt over provision. Either you can write it here or else under other income you can write 230. When you are writing in the selling and distribution, it will be minus. It's a credit. And finally, here it's 270. This is 630. Only this part will be the difference. Okay, so we did bad debt, provision for doubtful debt under provision, over provision, specific provision, and the general provision. Okay. So let's do one last question on this. Okay. Example 3. One last question on this. Trade receivables 1 million, bad debt 50, provision for doubtful debt is 400. So write the example 3. Same data, bad debt I change it to 50. Provision is it's taking 300,000. Additional information, bad debt is 100,000. A specific provision of 200,000 made for Mr. Pereira was treated as a bad debt. A specific provision made for Mr. Pereira was treated as a bad debt. General provision is 5% from the remaining trade receivables. General provision is 5% from the remaining trade receivables. So here in this question we have a specific provision becomes a bad debt. Okay. So draw the ledger accounts and the draft financial statements. So draw the format. Opening balances, trade receivables 1 million, provision for doubtful debt 300,000. In additional information, number 1 is bad debt 100,000. Number 2, a specific provision of 200,000 is made for Mr. Pereira was treated as a bad debt. So last year they have made a specific provision of 200,000. So it becomes bad debt this year. Then general provision is 5% from the remaining trade receivables. Right, shall we start? Okay. Additional information number 1. Bad debt 100,000. So the double entry for bad debt. Already there is 50. And we add another 100 as that. Credit receivables, debit bad debt expense. Okay. Then the second one, a specific provision of 200,000 made for Mr. Pereira was treated as a bad debt. So now we have a debtor called Mr. Pereira. He was already treated as a provision. If he becomes bad debt, we have to remove him from the trade receivables because he is here. He is in the trade receivables account. So we credit the trade receivable account, bad debt Mr. Pereira, which is 200,000. Trade receivables account credit, we are removing Mr. Pereira from our debtor balance. Then 200,000. Can you increase the bad debt? Can you take 200 here? You can't. Because already, when you make a provision, when you make a specific provision, the other entry is expense account debit, provision account credit. Already you make that provision. Therefore, you can't take this 200 again to the income statement. We credit the trade receivables and we have to debit the provision for doubtful debt. 200,000. Saying debtors, trade receivables. So you can say trade receivables. So that's the double entry. If you go back and check the double entry which I gave for this transaction, a specific provision becomes bad debt. A specific provision becomes bad debt. Double entry is debtors account credit, provision for doubtful debt account debit. That's the double entry. Okay. So this will be happening. Now to get the net debtor balance. Net debtor balance is 700,000. Trade receivables 700,000. Therefore, we calculate general provision of 5%. Doubtful debt. 5% out of 700,000. So 5%. 10% is 70, 5% is 35. Only 35 should be the provision for doubtful debt balance. Your balance should be 35. How much is available in the provision for doubtful debt account? We have a credit of 300, debit of 200, that means net is 100. But the closing balance should be 35. Right? So this is an over provision. Over provision is difference 100 minus 35. So if you take the difference in this account, you can get the over provision 65. Over provision is 65. So that we can take it here. Doubtful debt over provision 65 is minus. Deduct from the selling and distribution, or else under other income you can add it as an income over provision 65. So current assets, you have to take this 700 minus 35, 565. $665. Net data balance. So I hope it's clear. This part, if you have doubts, like you calculate the net amount from the remaining debtors, 5% should be the provision. So 5% is 35. That means your closing balance should be 35. If there is a difference, that difference only we need to transfer to the income statement. If it is in the credit side, it will be under provision. If the difference comes for the debit side, it is the over provision. So let me know for any doubts. So there is a question, why are we removing the 200,000 from the debtors account? The reason is now he is, we can't have his account because we have to treat Mr. Pereira as a bad debt. So if he is a bad debt, normal double entry is debtors account credit, income statement debit. But here already income statement has been debited last year. But we have to remove him from the debtors account. That is why debtors account is credited. And since the amount is credited to doubtful debt account, we have to debit the provision for doubtful debt account. Any other questions? Is it clear, Adil? Why are we reducing 35 when it is over provision? Yeah. So our normal provision is 35. So what they are saying is from the debtors, this should be 5%. We have to deduct 5%. Over provision comes when you compare with last year. Last year, if you take the net, it is 100. Net is 100. 300 includes a bad debt of 200. You remove 200. Then last year, general provision is 100. This year, general provision should be 5%. So when you compare 100 with 35, then only the over provision comes. So that over provision we treat it as minus income, minus expense, right? But this 5% is our normal provision for doubtful debt from the remaining debtors. So anyway, it has to be deducted from the trade receivables. Right? So over provision, under provision comes when you compare with the previous year. Right. So this is also okay. So let's move on to one more a small part. Right. So we will do one last area. I will explain the adjustment for inventory. So I have done the standard, the complete standard for inventory. Here, what I am going to explain is the summary, like we did for doubtful debt, uh, and also for the VAT. We will do a summary on the inventory. So under this, first one is closing stock. So when we are recording the closing stock, sometimes in some questions you will have only the cost, right? That means normally NRV is higher. Let's say cost is 100,000. NRV is normally higher, 120,000. Then double entry for this. When we are recording the closing stock, we have to take the lowest of cost and NRV. Then the double entry will be stock account debit. You can say closing stock account debit. Trading account credit. closing stock account debit, trading account credit. So I hope you can see the board. Then the second method, second situation, is cost is greater than NRV. Cost is 100, NRV is 70. So at this situation, we have to take NRV as the value of the stock, value of the inventory. Right? So the double entry will be there. If the NRV is less, this 30 we have to write off. We treat this as a loss. 30 will be treated as a loss. Then the double entry will be closing stock account debit. Is only 70. Closing stock goes to SOFP. Stock account debit 70. And 30 is an expense. Expense under other expense. Stock written off. The account is stock written off. Debit 30 under income statement other expense. Income statement other expense 30. And trading account we can credit the total amount which is 100. In trading account, where do you record? Under cost of sales minus closing stock. Cost of sales minus closing stock, you record 100. So these are the two things that we need to know under when recording the closing stock with the NRV, cost and NRV. Comparing cost and NRV. Then the second adjustment related to inventory. Stock damages and insurance claim. If our stock is damaged and if there is an insurance claim, so let's say the stock, the cost of the stock is 100,000 and completely damaged. Then the insurance company agrees to pay us 80% of the cost. Insurance company agrees to give us 80% of the cost. That means 80,000. Then what is the double entry? Double entry is insurance claim receivable. Debit 80. It's an asset. Under current asset, we will write insurance claim receivable. 80% of this is receivable. And the loss and the other expense, stock loss, is only 20. Stock loss is only 20. And trading account, we have to credit the total 100. So insurance claim receivable under SOFP, current asset. And this is income statement, other expense, stock loss under other expense. And this is income statement, cost of sales. Minus cost of sales before the closing stock. We have to record stock damages, stock losses, stock drawings and all comes under trading account before the closing stock. And one more important part, stock sold on sale or return basis. Stock sold on sale or return basis. Now this is another very important concept. Let's say, we take an example. Most of the times this is mainly used for perishable items like milk packets or yogurt, like vegetables, or any other food items. So the supplier will sell the goods on a condition. What is the condition? If it is sales, if it is sold, there is no issue. We will recognize as a sales. But if it is not sold, if end of the day, if there is a remaining stock, end of the day, if there is a remaining stock, it can be returned. So that is the condition, sale or return basis. So let's say we did a sales, 100,000. This includes cost is 8, right? Let's say cost is 100,000, profit is 20, sales value is 120. Right? 20% profit on cost. So we are doing a sales 120,000 with a profit margin of 20%. So if we are recording the sales 120, what is the double entry? Double entry will be sales account credit 120 and the debtors account debit 120. So that's the double entry for recording the sales. Right? That's the double entry for recording the sales. That if it is sold, there is no issue. You will keep this entry and you will prepare the financial statement. But let's say 50% of this, not sold. Then what we need to do? We need to do the reversal. 50% of this is reverse. So what's the double entry? What's the value? 60 is the selling price. 50% means selling price will be 60, cost will be 50, profit will be 10. So we need to remove the sales entry, reversal of sales. So what's the reversal of sales? Sales account debit 60 and the debtors account we have to credit 60 because it is not sold. So not only this, then we will receive the stock. So what's the value of stock? It is 50. So closing stock will increase by 50. Closing stock will increase by 50. So when we are preparing the income statement under closing stock, you will have the closing stock value which is given in the additional information. So for that, we need to add back this unsold goods worth of 50,000. So that is the third part under inventory. So we need closing stock, cost and NRV calculation if the cost is less and if the cost is more. Then stock damages and insurance claim. Then stock sold on sale or return basis. And also if you want, we can take stock drawings. That's a simple double entry. If owner takes goods from the business, the double entry will be drawings account debit and trading account credit. This is also before the closing stock. For the closing stock minus drawings, stock drawings. Right. So these are the areas which we need under inventory. Right. So we have few more areas under the preparation of financial statement. So we will have one more day to cover that. So on Thursday, I will be covering up all the past paper questions related to this, and including preparing a full complete question and past papers. So I hope today's session is clear. And give me your comments on the previous method or this method is better. So on your comments, I can continue this way or I can use the screen sharing method. Okay. Any questions you can ask? There is one question. So is stock loss and stock written off the same thing? Stock written off means writing off the stock, comparing with NRV. If the cost is, if the NRV is less, we write off. Stock loss means it is a loss, maybe from a fire or from any other disaster, or it can be, expired. So those things we call it stock losses. Right. So if you have questions, you can ask. Since no questions, we'll wind up for today. So Thursday, I will be doing the preparation of financial statements, the complete question, including income statement and statement of financial position. Right. So in between, if you have doubts, you can send me a message. Right. So see you on Thursday.